You know the charts. You can analyze demand zones, predict reactions, and draw trend lines better than you ever could before. This is the intermediate plateau. It's the worst stage of trading because your technical skill is high, maybe 8 out of 10, but your profitability remains a hard 0. You have moved past the beginner's stage of pure ignorance. You have a system. You know what to do. Yet, when the bell rings, you execute something entirely different. Why? It's the most brutal paradox of this profession. You are losing not because your strategy is flawed, but because your self-control has a catastrophic failure rate. You have the map, but you keep driving off the road. The problem isn't the market structure or the news cycle. The problem is the invisible trap. It happens in the narrow window between identifying your A-plus setup and actually pulling the trigger. 90 seconds. That's all the time your mind needs to sabotage a month of perfect backtesting. We call this psychological leakage. You've mastered the entry mechanics, but you haven't mastered the waiting mechanics. You watch the chart, you see the conditions aligning, and then a faint, insistent pressure begins to build in your chest. That pressure is the market testing your discipline, finding the weakest point in your armor, which is always your need to be in the action. You feel the urge to step in early. You feel the urge to compromise. This is where the true enemy emerges. Let's name him the setup thief. He doesn't steal your money directly. He steals your conviction. The setup thief is that internal voice that whispers, "This B- setup is good enough. Don't let the day go by empty. Just get a small piece." He is the voice of compromise, disguised as pragmatism. He convinces you to loosen your criteria, to accept the C-grade trade because waiting for the A-plus trade feels like passivity. You think waiting is weak. You confuse patience with inaction. But that compromise, that small mental slippage, is exactly why your account equity looks like a flat line. You aren't losing money on your best trades. You are bleeding out slowly on the trades you knew you shouldn't have taken. You are losing because you cannot stomach the stillness required to let perfection ripen. Understand this. Waiting is not a neutral state. Waiting is an aggressive, proactive act of self-defense. It is the highest form of self-control a trader can exhibit. When you sit on your hands, refusing to engage with the B-grade noise, you are not being passive. You are deploying psychological capital. You are preserving your focus and your financial ammunition for the moment when the market is forced to meet your terms. You are saying, "I will not chase. I will not compromise. I dictate the rules of engagement." This is the core shift. You know the strategy. You know the charts. The reason you lose is not technical. It is a hidden, ego-driven decision point that happens in that 90-second window. It is the point where you choose immediate gratification over delayed, guaranteed profit. You believe you are trading the chart, but in reality, you are trading your internal emotional state. And until you identify why your ego insists on settling for less than optimal, that plateau will remain unbreakable. You must stop believing that trading is about finding opportunity. It is about rejecting opportunity. The key is in mastering the single golden rule of self-control, which is far simpler and far more brutal than you imagine. It has nothing to do with charts and everything to do with what you tolerate. What you tolerate defines your P and L. The golden rule is this: you are not ready to trade until you are ready to walk away from the best-looking setup you have ever seen. We look for an A-plus setup on the chart, but we forget that the A-plus setup requires an A-plus trader. What does that even mean? It means your technical analysis is irrelevant if your internal state is compromised. An A-plus setup is not just a confluence of moving averages and volume spikes. It is a confluence of market conditions and psychological conditions. If you are stressed, if you are chasing yesterday's losses, if you are trading on 3 hours of sleep, that setup is immediately downgraded to a D-. The market doesn't care about your pattern recognition. It cares about your discipline. This is the fundamental difference between a good setup and a ready setup. A good setup exists on the screen. A ready setup exists in your mind. You have certainly seen those perfect flags, those textbook head and shoulders patterns that you skipped, only to watch them print massive gains. That sting, that sharp regret, That is the internal enemy whispering that you missed the boat. But here is the brutal truth. If you are trading a good setup while internally stressed or desperate, you are guaranteed to manage the trade poorly. You will cut winners too early, or worse, you will let losers run too long because you need that win to validate your decision. The technical edge is instantly erased by the emotional drag. That setup wasn't for you. Not yet. Why do we settle for less? Because of the perceived cost of waiting. We fear the missed profit. We fear watching that trade run without us, feeling that sharp FOMO pain, that sense of being left behind. This is the irrational calculation of the intermediate trader. You believe the cost of waiting is high. But let's look at the true cost, the cost of trading. A B setup when you are not ready is mathematically certain. It is a guaranteed erosion of capital, confidence, and peace of mind. The cost of waiting is merely potential profit loss. The cost of trading poorly is actual capital destruction. Stop confusing potential regret with actual risk. It's a tax on impatience that you pay every time you click the mouse prematurely. This brings us to the principle of certainty reduction. The market is inherently random, but we, as humans, crave certainty. When we feel uncertainty, we try to reduce it by taking action, any action. We scroll through charts until we find a pattern. We force entries based on flimsy indicators. We over-leverage. We are trying to buy certainty with our risk capital. This is the exact moment the setup fails. The A+ setup does not require certainty. It requires probability. And probability is only accessible when you are calm enough to read the data without emotional interference. When you feel a desperate need to be right, when you feel the trade must work out, you are operating outside the parameters of an A+ trade. You have added ego to the equation. How do you know if you are truly entering an A+ setup? Listen to your body. If your heart is racing, if your hands are sweating, if you feel a surge of excitement or anticipation, you are rushing. That is the ego demanding immediate gratification. That is not an A+ entry. An A+ entry should feel clinical. It should feel boring. It is merely the mechanical execution of a predefined plan. It is the simple robotic act of pressing the button because the conditions you defined yesterday have been met today. There is no joy, no rush, no hope in the entry, only adherence. If the entry feels good, you are probably wrong. The feeling of goodness belongs to the outcome, not the process. The process must be purely mechanical, free from the contamination of desire. The true A+ setup is the one you can execute without emotional attachment. It is the trade where you have fully accepted the risk before you click the mouse, meaning the outcome, win or lose, changes nothing about your internal state. You are simply processing data. If you cannot achieve that level of emotional neutrality, you are not trading the market. You are trading your internal fear. And that is a market you will always lose. The question then shifts from what setup you are looking for to who you need to be to execute it. This neutrality, this boring adherence to the plan, requires a specific, actionable process of self-management that most traders completely ignore. It is the building of a psychological firewall that separates your capital from your emotions. But how do you actually build that firewall when the market is screaming at you to act? The answer is painful, but essential. You build that firewall by accepting the golden rule of self-control. And here is the paradox. True self-control in trading is not about forcing your will onto the charts. It is the exact opposite. True self-control requires the complete and utter surrender of your need to control the market's outcome. Think about that for a second. The moment you believe your actions can dictate where the next candle closes, the market has already won. That belief, that delusion of influence, is the trigger that activates your emotional brain. The limbic system that only understands fear and scarcity. When you try to force control, you are not trading. You are negotiating with reality. And reality never negotiates. You are injecting your ego into the process, hoping that sheer willpower can bend the odds. This is why you chase trades. This is why you widen your stops. You are desperately trying to assert authority where you have none. The market responds to this emotional energy by crushing it. The solution is to move the locus of control entirely. You must shift your discipline away from the moment of execution and apply it hours, sometimes days, before the trade ever happens. This is preemptive discipline. Preemptive discipline is self-control applied when the stakes are zero. It's the hard work you do when the market is closed, defining your non-negotiable line in the sand. What is an A+ setup? You need to write down, in unforgiving detail, the 3 to 5 criteria that must be present for you to even consider risking capital. The color of the bar, the time of day, the proximity to a key zone. If even one criterion is missing, the trade does not exist. It is a ghost. It is a phantom. Most traders define their setups vaguely, giving themselves emotional wiggle room to enter based on a feeling. That wiggle room is where the monster of greed hides. We talk about patience in trading as if it's a passive virtue, like sitting still and breathing. That's wrong. Patience is passive. Disciplined waiting is an active skill. Patience is hoping the price comes to you. Disciplined waiting is the active, internal refusal to accept anything less than your predefined, non-negotiable criteria. It is the act of looking at a B setup, recognizing it will probably move, and still walking away. That walk away is the trade. That is the execution of your plan. This is the hardest psychological shift to make because our entire societal structure rewards immediate action. If you are sitting on your hands for 3 hours waiting for the perfect confluence, your brain is screaming that you are lazy, that you are missing opportunity. This is the noise you must silence. Why do we struggle so much with waiting? It's simple. Emotional trading is driven by the desire for immediate validation. We want to be right now. We want the market to confirm our intelligence. The market doesn't care about your intelligence. When you enter a mediocre trade, you're placing a bet on validation. You are hoping the immediate rush of being in the market will satisfy the underlying anxiety of uncertainty. But that rush is a poison. It's a cheap dopamine hit that costs you capital and confidence in the long run. Every time you take a B setup, you are teaching yourself that your rules are suggestions, not laws. You are eroding the very foundation of your discipline for a fleeting feeling of purpose. Stop seeking validation from the charts. The market is designed to reward the disciplined waiter and punish the emotional actor. The price moves in waves, and 80% of those waves are noise. Your A+ setup lives in the 20% of pure signal. If you trade the noise, you are guaranteeing mediocrity. If you wait for the signal, you are guaranteeing an edge. This brings us back to the core paradox of self-control. Your only real power lies in your ability to wait, and your ability to exit when the criteria are violated. That is it. You have zero power over the price movement. Zero. Admitting this powerlessness is the single most powerful act of control you can perform. When you truly internalize that the market owes you nothing, that your analysis is merely a probability assessment, not a prophecy, the emotional pressure lifts. You are no longer fighting the tape. You are simply managing probabilities. The surrender of the outcome is the acquisition of process control. It sounds like a spiritual teaching, but it is the hardest tactical move you can make. The moment you stop needing the market to reward your effort, you free yourself to trade correctly. You shift from being a gambler hoping for a hit to being a manager executing a calculated edge. But execution requires a system for managing the inevitable drawdowns, the inevitable losses that still occur even with A+ setups. Because if you panic on the first loss, the whole structure collapses. How do you handle the psychological burden of being right about the setup, yet still losing money? That psychological burden is where the true battle is fought. Because the moment you experience a loss, even a small, calculated one, the clock in your mind accelerates. The ego perceives a deficit, and its primary directive is to recover it immediately. This is the source code for impatience. You are no longer waiting for the A+ setup. You are waiting for anything that moves because the market has just taken something from you, and your ego demands it back now. This is the insidious root of FOMO. Fear of missing out is not really about missing money. It is about missing the validation you believe that trade would provide. It is a sign of low self-worth projecting onto external success. The ego whispers, "It is leaving without you." It treats the market like a departing train, suggesting this specific opportunity is finite and irreplaceable. This is the lie of the one-trade illusion. Your account is finite, yes, but the market's opportunities are infinite. There will be another setup in 30 minutes or 3 hours or tomorrow. The moment you internalize that truth, the urgency collapses. The clock slows down. You must stop treating the market like a desperate deadline. It is not a test of speed. It is a test of stillness. The greatest challenge for the intermediate trader is not identifying the setup. It is managing the waiting period between setups. If you are sitting there staring at the screen for 4 hours, willing the market to move into your zone, you are draining your mental capital, and you will eventually force a trade simply to relieve the tension of the wait. We need a system for temporal compression. You have to learn how to shrink the perceived time between A-plus setups. If you define your edge so narrowly that your setups only occur twice a day, you cannot spend the intervening hours in a state of high alert. That is unsustainable. Use the waiting time for non-market tasks. Review your trading journal. Not just the winning trades, but the trades you didn't take. Study the market structure one time frame lower or higher, looking for confirmation, not entry signals. Read a chapter of a book. Exercise. The market is running its course whether you are watching or not. When you are engaged in productive patience, you are reframing the wait from passive inactivity to active discipline. The true master knows how to sit on their hands. And this brings us to the most vital exercise in psychological training, neutral observation. You must intentionally watch B-grade or C-grade setups move significantly without participating. This requires immense psychological strength. You see the pattern that almost meets your criteria. You see it move 50 points. You feel the gut punch of regret, the urge to jump in late. But you hold your criteria. You let the move go. Why? Because you are training your mind that opportunities are infinite and not every move is yours to capture. You are proving that your discipline is worth more than the potential profit of a suboptimal trade. If you can watch a major move without trading it and feel nothing, no regret, no anger, only calm observation, you have won the psychological battle. You have successfully separated your self-worth from market performance. This is what mastery feels like. It does not feel like adrenaline, excitement, or genius. It feels like clinical, almost boring, calm confidence. You are not waiting for the market to give you permission. You are waiting for the market to meet your predefined demands. If it doesn't, you simply don't engage. The paradox is that the more comfortable you become with not trading, the more confident you become in the trades you actually take. The goal is to make the process of waiting feel safe and productive, and the act of trading feel inevitable and clinical. The final test of this waiting game is the moment the A-plus setup finally materializes. You have mastered the patience, you have defeated the ego's clock, you have utilized temporal compression. Now the chart aligns perfectly with your criteria. The signal is flashing green. The question then becomes, after all that waiting, all that discipline, are you ready to commit? Because the fear of sitting on the sidelines is often replaced by the fear of being wrong when you finally pull the trigger. That commitment, the moment you risk capital after prolonged stillness, is the final barrier to consistency. That final barrier isn't overcome by grit. It is overcome by architecture. Discipline is not a feeling you conjure. It is a system you install. Relying on willpower alone is a guaranteed path to failure because willpower is a finite resource. It diminishes throughout the day, corroded by minor decisions and emotional friction. By the time the B setup flashes, the setup that looks almost perfect, you are already emotionally drained from the waiting. You attempt to enter a high-stakes arena relying on an empty fuel tank. This is why you need automation. You need to remove the moment of choice entirely. This automation is called implementation intention. It is the ultimate pre-commitment strategy. You decide, now, in the calm, rational moment, what you will do later, when the stress hits. You write the trigger and the response as a non-negotiable command. You must define your red line. Write it down. If I see a setup that violates more than one rule on my checklist, a B setup, then I will physically close the charting software and set a 30-minute timer. This isn't a suggestion. It's a command to your future, stressed self. You eliminate the agonizing internal debate, the very moment where undisciplined traders fail. The debate is the killer. The system is the savior. Discipline is often just environmental control. If you cannot stop yourself from clicking, you must physically remove the click. The market is designed to tempt you, to pull you into a state of continuous interaction. Use tools that enforce stillness. Close the chart entirely if you are between A+ setups. But for the moment of execution, you need friction. You need to slow yourself down. I call this the checklist lockout. Before you can execute any trade, you must physically interact with your system in a way that creates resistance. Print your checklist. Put it under a heavy object, a stone, a brick, something substantial. You must lift that object, read the checklist aloud, and physically tick every box before you are allowed to touch the mouse or the keyboard. That moment of friction, that physical resistance, is a pattern interrupt that forces your rational prefrontal cortex back online. It halts the impulsive rush of the emotional brain long enough for sanity to return. We mentally rehearse our entries constantly. We visualize the profit target and the perfect execution. But how often do you rehearse ignoring a setup? You must train your mind to actively ignore B setups. Visualize the mediocre signal appearing. Feel the subtle, toxic pull of FOMO, the fear that this is the one you should have taken. Now visualize yourself slowly leaning back, taking a deep breath, and closing the screen. You're not missing an opportunity. You are protecting your capital's energy for the perfect moment. You are rehearsing the peace that comes from correct inaction. If you feel regret after missing a B setup, you haven't internalized the true cost of inconsistency. You are still trading for entertainment, not for edge. This leads to the most powerful friction strategy you can employ. The 10-minute rule. If a setup appears and you feel even the slightest internal hesitation, if it is not an explicit, screaming A+ setup that matches your written plan precisely, you must physically stand up, walk away from the desk, and set a 10-minute timer. Do not look at the screen. Do not check your phone. You must break the visual and mental trance the market casts upon you. When you return, the market context will have shifted and the emotional urgency will have dissolved. If it was truly an A+ setup, it will still be there, or the entry will have clarified. But 9 times out of 10, that 10 minutes saves you from an emotional decision. It forces you to commit to the highest standard. Because every B trade you take is not just a loss of capital, it is a profound loss of self-trust. You signal to your subconscious that your rules are flexible, that your plan is negotiable, and that self-trust, that deep, quiet confidence in your own system, is the ultimate currency of the consistent trader. But how do you rebuild that trust once it has been shattered by months of impulsive, rule-breaking decisions? You rebuild it by understanding the true, compounding cost of the sloppy trade. Most traders calculate their losses purely in dollars. They see a red number and they accept the monetary consequence. This is the amateur calculation. The consistent trader understands that every B or C setup you force, every trade you take out of boredom or frustration, carries an emotional debt far greater than the capital risked. This is emotional accounting, and it is the single most important ledger you keep. When you break your rule for a mediocre setup and it fails, which it often will, you don't just lose $100. You activate the confidence erosion multiplier. That one impulsive loss doesn't just subtract the risk amount. It multiplies the doubt you feel when the real A+ setup finally appears tomorrow. You will hesitate on the winner because you are still emotionally compromised by the loser you knew you shouldn't have taken. This is the definition of a poisoned mindset. You have successfully sabotaged your ability to execute when execution matters most. Are you paying attention to that cost? Beyond confidence, there is the cost of mental energy. When you enter a trade based on impatience, you immediately commit a significant portion of your mental bandwidth to managing a mistake. You are now nursing a position you don't fully believe in. This consumes focus. It consumes discipline. It creates noise. You spend the next 3 hours micromanaging the stop loss, checking social media for validation, and arguing with yourself about whether to scale out prematurely. This is the opportunity cost of time. While you are consumed by the drama of a poor entry, the market is moving. The genuine high-probability A+ setup is forming perfectly on another chart, but you are too mentally exhausted and distracted by the C setup fire you started to even notice it. You missed the easy money because you were busy defending the hard mistake. This is the feedback loop that traps the intermediate trader. Impatience leads to a forced trade. The forced trade leads to a loss. The loss immediately generates intense self-criticism, frustration, and often shame. That negative emotional state then depletes the mental reserves required for patience, making you more susceptible to the next impulsive trade. It is a self-fulfilling prophecy of underperformance. You are trading poorly because you feel poorly, and you feel poorly because you traded poorly. How do you break this cycle? You stop focusing on the feeling, and you start focusing on the data. You must shift from emotional judgment to objective analysis. I want you to perform a thought exercise right now. Look back at your last 20 losing trades. Be brutally honest, not with your bank account, but with your entry criteria. Take a moment and calculate the percentage. What percentage of those losses came from setups where, in the moment you pressed the button, you intellectually knew it was not an A+ setup? You knew it lacked confirmation. You knew the risk to reward was slightly skewed. You knew you were just tired of waiting. If that number is anything over 10%, your problem is not the market, and it is not your strategy. Your problem is your standard operating procedure for patience. You are allowing the minor discomfort of waiting to dictate the major outcome of your performance. You are trading your fear of missing out, not your edge. The vast majority of the time, the loss that crushes your capital and your confidence is not the one the market delivered unexpectedly. It is the one you ordered yourself, knowing the ingredients were stale. The solution, then, is not complicated, but it is deeply uncomfortable. It requires mastering the pause button, mastering the art of the A+ wait. It requires a radical, uncompromising commitment to the golden rule of self-control. If it is not the best, you do not touch it. But how do you cultivate that stillness, that unwavering discipline, when the market is screaming at you to act? The market screams because you have trained it to scream. You have taught your subconscious that impatience will be rewarded, or at least immediately satiated. To break this cycle, we need to introduce a mechanism of radical temporal commitment. We need the temporal lock. This is the foundation of the 48-hour rule. It is a psychological commitment, a pre-trade contract you sign with yourself that states you will not execute a single trade on a specific instrument for the next 2 trading days unless that setup meets 3 non-negotiable, high-time frame criteria. These must be defined with brutal clarity, not as vague feelings, but as measurable data points. Let's call them X, Y, and Z. X might be confirmed structural break on the daily chart, closing above or below the previous month's range extreme. Y might be volume profile confirmation, meaning the current price action is testing the highest volume node from the last 6 months. Z might be momentum divergence confirmed on the 4-hour chart, signaling exhaustion of the prior trend. If one of these is missing, the lock remains engaged. You are psychologically barred from entering. The 48-hour window is critical because it forces you to look beyond the immediate noise of the 5-minute chart. It forces you to respect the major cycles and to bypass the urge to fill time with low-quality activity. This rule fundamentally shifts your identity from a gatherer to a hunter. Gatherers pick up scraps, reacting to movement, chasing volatility. Hunters are patient predators. They know their prey's habits, they understand the terrain, and they wait, sometimes for days, for the perfect alignment of wind and light. When the moment arrives, the execution is swift, precise, and highly capitalized. You are not meant to be busy. You are meant to be devastatingly effective. This shift, this refusal to trade mediocre setups, is what creates psychological leverage. Think about your mental capital. When you trade 10 times a week, your conviction is diluted. Each loss cuts deeper because you are already mentally fatigued from the preceding 9 executions. You are trading on residual charge. But when you trade once, maybe twice a week, that single trade carries the full weight of your focus, your review, and your conviction. You are trading with a full battery, fully rested, and fully committed to the process. This is leverage no broker can offer you. It is the compounding power of mental clarity. Less trading, paradoxically, means higher mental leverage on every single position you take. What do you do with the time the 48-hour lock frees up? You review, rigorously. The energy you used to burn on impulsive entry and anxiety-ridden management is now channeled into backtesting, journaling, and observing the market as a neutral third party. You are using the market as a mirror to understand your internal biases, rather than using it as a battlefield to prove your ego right. This is where the fear surfaces. The quiet voice whispers, "What if the perfect setup happens and the market moves without me?" This is the core irrationality we must confront. The market owes you nothing. It does not care about your account size or your desire for excitement. The fear of missing out, or FOMO, is rooted in the scarcity mindset. The belief that this specific moment, this single candlestick, is the only opportunity you will ever be given. That is a lie your ego tells you to justify poor execution. A massive move missed because you stuck rigidly to your XYZ criteria is not a failure. It is the highest form of success. It is proof that your discipline is stronger than your desire for instant gratification. It is proof that you trust your process more than the market's noise. The market is infinitely deep. If you miss this wave, another, likely better, wave will form. Your job is not to catch every ripple. Your job is to catch the tidal wave that aligns perfectly with your edge. I challenge you to adopt this 48-hour temporal lock for just 1 week. 7 calendar days. Define your X, Y, and Z, and then commit to absolute stillness until those conditions are met. Watch the stress melt away. You will realize that 90% of your trading anxiety was self-inflicted, generated by forcing trades where no edge existed. The goal is not profit this week. The goal is silence. The goal is to prove to yourself that you possess the self-control to wait for undeniable opportunity. Once you have mastered the wait, we can discuss the final element, the specific mental checklist that turns a confirmed A+ setup into a high-conviction, high-payload execution. It is the difference between simply seeing the setup and knowing, deep in your core, that this trade is mathematically and psychologically yours to take. The true secret to self-control isn't about exerting massive effort. It is the paradoxical, often painful, absence of effort. This is the golden rule of trading psychology. Self-control is the absence of effort to control the uncontrollable. Think about that for a moment. You are not trying to force the market to move in your direction. You are trying to stop yourself from moving when you shouldn't. The only thing you can truly control is your own trigger finger, your own internal discipline. Everything else is external noise, noise you must learn to ignore. The market is a perfect, merciless feedback mechanism for this truth. It doesn't reward intelligence. It rewards consistency and patience. Specifically, it punishes the effort of control. When you try to will a trade into existence, when you lower your standards just to feel the rush of action, the market sees it. It reads your emotional desperation, your need for instant gratification, and it takes your capital. It is a tax on the ego. Mastery in this endeavor is not a sprint of heroic action. It is a marathon of boredom, punctuated by moments of extreme, precise execution. You must become comfortable with doing nothing. You must learn to love the silence between the setups, because that silence is where your capital is preserved and your mental edge is sharpened. The intermediate trader believes they must constantly trade to make money. The master understands they must wait to capture asymmetry. Do you have the internal fortitude to stare at a clean chart for 3 hours, see nothing that meets your standard, and walk away knowing you did your job perfectly? Most do not. Their ego demands action, demands proof of effort. This is precisely why the A-plus setup must be defined with military rigor. It cannot be ambiguous. It cannot have wiggle room for your emotional brain to argue, well, maybe this counts. If your rules are fuzzy, your ego will exploit those gray areas every single time, turning high-conviction trades into coin flips. Define the entry, the confirmation sequence, and the risk parameters so clearly that when the moment arrives, execution is automatic. Remove the need for internal debate. The waiting, the silent adherence to your defined standard, must become your core strategy. The execution is merely the consequence of successful waiting. When you truly internalize this, the market stops feeling like a battleground and starts feeling like a predictable clock. It is simply waiting for the conditions to align. Your job is not to predict the next hour. Your job is to survive the next week, the next month, the next year by adhering to the standard you set. The market rewards silent, disciplined execution of patience. It rewards the trader who is willing to let the vast majority of opportunities pass by, preserving their energy for the one setup that drastically changes the shape of their equity curve. The conviction comes not from the chart, but from the unwavering process. But now we must address the final step, the specific mental checklist that eliminates hesitation and allows for high-conviction execution when the A-plus conditions are finally met, turning patience into profit.